How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is episode 31 to the Asian Session Library. On Monday, the 29th, January 2024, we had another successful Asian Session model with the pair US dollar versus Japanese yen. Now, do know that this series, this library, only speaks about the successful Asian Session setups. Yes, there are opportunities where the setup does fail, but this series is mainly highlighting the success with the model. There's definitely going to be failures with the model. Nobody said that this model was 100% guaranteed. Let's follow along. So we are marking off the swing highs and swing lows that we have available in the New York lunch session. So this is the New York lunch. And this is going to be 12 p.m. to 8 p.m. This is where most likely the market's going to go in a phase of consolidation or accumulation. We're looking to trade in the Asian sessions, hence the name Asian session model. So Asian open or Asian kill zone, whatever you want to call it. So 12 a.m. We're trying to use these liquidity pools to frame context to find a setup here. A very simplistic idea. You have the opening price here. And this one was very interesting because this is something that people may not have gauged or may not see it this way. When you play it forward here, we can see we do, in theory, get a swing high formation here. There's another one I didn't mark off here. Just mark it off there. This is a swing high formation. So in theory, I know it's not confirmed because this candle or the next couple candles doesn't come down here yet, but we can see that this is a swing high formation because there's a lower high on the left and a lower high on the right, and it lands within the time period of 12 p.m. to 8 p.m. This does not land outside of it. It lands right here on the 15-minute time frame via 15-minute right there. So we're going to take this as a buy-side liquidity pool as well, or part of the New York lunch. We play it forward. You can see now that swing high is confirmed here because it definitely breaks the low here. Keep playing. And eventually we break that buy-side liquidity pool here. At this point, what I personally do is I go down to the 1 minute to look for an entry technique to be counterparty to those that are looking for the breakout higher. I want to be going short against those retail traders that are going long. So let's go down to the 1 minute. This is not to say you can't use this model for other pairs or you can't use other time frames to find entries. So sometimes entries do find itself on a 2 minute, 3 minute, and the 5 minute. But the specific entry technique that I am showing the community has to look like this. So play it forward. There it is. So it has to be a swing low that is broken with a fair value gap after breaking a buy side liquidity pool and being above the Asian Open. Because we know anything above the Asian Open is going to be a premium. And that's going to be ideal for selling opportunities. We want to sell in an overbought condition. We don't need an indicator to tell us where to sell. But there needs to be context of why we're selling. I'm not just selling at any random fair value gap. And I'm not selling at any point. I need to see a level rated first, then I will look to sell. Now there's multiple fair value gaps here. You can see here, 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 and there may be selling opportunities there, here, but eventually we can see how all that is just washed over and just forgotten about. But then this one shows itself, and that's the one I prefer. I'm not telling people how to trade the Asian session model. I'm just showing people how I find success with the model and how I find success with the Asian session in general. You can take this model and apply other entry techniques. I've showed this numerous of times. You could take other ideologies and methodologies and apply it here. You can optimize the model to your liking. Sometimes you might be under optimizing it too, because sometimes doing a lot more can actually bring down the trading results or the success rate for the model because you may think you're making it better, but you're actually not. So just be, on your P's and Q's about that. But best believe you can optimize it to whatever playing field you would like. So that's the entry technique, fair value gap through the swing low. What are we going to do? We're going to go short We're looking for 15 pips profit and 15 pips stop loss, risking anywhere from 1% to 3% per trade, or even half percent if you're very conservative. And that's what I like to see. At least our take profit is somewhere within the lines of, fair value here. So I'm glad that it lines up here because it gives me a lot more confidence here. Let's play it forward to see what happens. You see price respects that zone. That fair value got really well. Gives us 10 pips in profit. So we could scale out there for sure. And going into IPTA true day range, we can see if we were still holding that trade. We can definitely see how we're able to get the 15 pips there. So we draw that out. Yeah. So able to get that movement to that desired 15 pips or that 1% or 2% or whatever the percentage is that you're risking per trade. I'm not telling people that this trade idea happens every single day for the pair that you're watching, because you guys know in the Telegram channel, in the chat, that there are days where it does fail. And I publicly show that in the Telegram channel. Here on the channel itself, the YouTube channel in the series, I just want to show successful models. I know you guys are very intelligent beings, and I know you guys know that there's not a trading model that's 100% foolproof. There's going to be days where it's the luck of the draw, and that day is just a loser. But taking a loss isn't the end of the world. We have no fear of losing because we're risking properly. That proper risk management allows us to have no fear in losing, because we know if the model is going to be based on data, we can still take trades and potentially get ourselves out that hole and reduce the risk, mitigate those losses, trading the model day in, day out until we mitigate those losses. Then we can stack back on that full percent that we normally risk. So if this trade was a loser today, right, for this example, if it was a loser and I risk 1%, that means the next agent session model that I'm trading, I'm risking 0.5%. And then the next one, I'm risking another 0.5%. Until I gain back that 1%, then I can start risking 1% per trade again. And that's how you maintain your account and you spread your equity across long periods of time. You're trying to get as many trades as you can possible with your equity. You're not trying to blow through your funds very fast. As your account grows, you will start to see you can start to risk more. That's the advantages of larger account sizes. But if you have a smaller account, take your time. Take your time. Hopefully you found this insightful. Peace.